How to understand and use financial ratios. 1. Understand financial ratios. Financial ratios are metrics used to evaluate a company's performance and financial health. They are derived from a company's financial statements and provide insights into profitability, liquidity, efficiency, and solvency. Common financial ratios include the price-to-earnings (P/E) ratio, current ratio, return on equity (ROE), and debt-to-equity ratio. 2. Profitability ratios. Profitability ratios assess a company's ability to generate profit relative to its revenue, assets, or equity. Key ratios include gross profit margin, gross profit, revenue, times 100. Measures the percentage of revenue that exceeds the cost of goods sold. Net profit margin, net income, revenue, times 100. Indicates the percentage of revenue remaining after all expenses. Understanding these ratios helps evaluate how effectively a company is converting revenue into profits. 3. Liquidity ratios. Liquidity ratios gauge a company's ability to meet short-term obligations. Key ratios include current ratio, current assets, current liabilities. Indicates whether a company can cover its short-term liabilities with its short-term assets. Quick ratio, current assets, inventory, current liabilities. Provides a more stringent measure of liquidity by excluding inventory. These ratios are crucial for assessing a company's short-term financial stability. 4. Leverage ratios. Leverage ratios measure a company's debt levels relative to its equity or assets. Key ratios include debt-to-equity ratio, total debt, total equity. Shows the proportion of debt used to finance assets compared to equity. Interest coverage ratio, EBIT, interest expense. Assesses a company's ability to pay interest on its debt from its earnings. Leverage ratios help evaluate the risk associated with a company's capital structure. 5. Efficiency ratios. Efficiency ratios analyze how effectively a company utilizes its assets and resources. Key ratios include inventory turnover ratio, cost of goods sold, average inventory. Measures how quickly inventory is sold and replaced. Receivables turnover ratio, revenue, average accounts receivable. Indicates how efficiently a company collects receivables. These ratios are essential for understanding operational efficiency and asset management. 6. Valuation ratios. Valuation ratios help determine the market value of a company's stock relative to its financial performance. Key ratios include price-to-earnings (P/E) ratio, market price per share, earnings per share. Indicates how much investors are willing to pay for each dollar of earnings. Price-to-book (P/B) ratio, market price per share, book value per share. Compares a stock's market value to its book value. Valuation ratios assist investors in assessing whether a stock is overvalued or undervalued. 7. Compare ratios over time. To gain meaningful insights, compare financial ratios over multiple periods. Analyzing trends over time helps identify improvements or deteriorations in financial performance. It also provides context for understanding how a company's financial health evolves. 8. Benchmark against industry peers. Compare a company's financial ratios with industry averages and competitors. Benchmarking helps assess relative performance and competitiveness within the industry. It provides a clearer picture of how a company performs compared to its peers. 9. Use ratios in context. While financial ratios are valuable, they should be used in conjunction with other financial and qualitative information. Consider the company's industry, market conditions, and economic environment when interpreting ratios. Ratios alone may not provide a complete picture of a company's financial health. 10. Apply ratios to investment decisions. Incorporate financial ratios into your investment analysis to make informed decisions. Use them to evaluate investment opportunities, assess risk, and compare potential investments. Ratios provide a structured approach to analyzing financial statements and assessing a company's investment potential. Understanding and using financial ratios effectively involves knowing the key metrics, interpreting them in context, and applying them to evaluate financial health and make informed investment decisions.